Hi friends, welcome to the NPTEL course Leadership for India Inc. Practical Concepts and Constructs. We are in week 8 discussing functional leadership models. In this lecture we will discuss finance leadership. As in the case of R&D leadership, operations leadership and marketing leadership which we covered in the last 3 lectures, we will first focus on the domain and the various factors that drive the domain and then come to finance leadership per se. Finance leader, usually the chief financial officer or the CFO, is entrusted with developing and executing the financial strategy of a firm. It is a set of integrated financial goals and activities planned for a firm covering multiple domains of the company so that the firm can grow profitably, maximizing value for its shareholders. Financial strategy is developed pursuant to the business strategy and also the various supporting functional strategies of the firm. However, financial strategy doesn't mean all of these things have to be just converted into numbers or into financial terms. It is broader than that. It addresses the SWOT of the company from strategic and operational as well as financial perspectives. The financial strategy of a firm typically covers a reasonably long-term horizon of at least 5 years. The first year of the financial plan also serves as the annual budget of the company. Financial leadership addresses several key questions of strategy and operations that arise from and also impact the financial position of the company on an ongoing basis. Financial leader needs to be a business partner as well as an ombudsman for the company. The leader has to be a partner of the business. He should also be the protector of the business. He should be approver of expenditure and investments, but should also be monitor of all financial matters of the company. Financial strategy, as I said, has linkages with every other strategy of the company, be it product strategy, technology strategy, operations strategy, sales and marketing strategy, human resource strategy, or the business strategy. The financial leader must play multiple roles from enabling to disabling to ensure that the finances of the firm are managed in a prudential manner. The fiducial responsibility must weigh heavily on the financial leader. Financial strategy of a firm addresses several key questions such as what are the assets and liabilities of the firm? What is the profit or loss arising from the firm's operations? The profit and loss account and the balance sheet of the company provide a picture of the financial health and strength of the firm at a glance. These also reflect the integrity of finances in a company. What is the profitability of each of the products and the product portfolio as a whole? Establishing product profitability based on analysis of product-wise prices and costs is an important driver of both tactical and strategic operations of the company. Another question that finance addresses is this: what are the implications of different manufacturing options in terms of break-even levels, profitability parameters, and the means of finance? In the post-COVID situation, many companies have encountered severe loss of production, and some of the companies also had almost zero sales. In matters such as these, finance plays a huge strategic role. The finance department should not say that it is zero sale, therefore everything must be at zero cost level. It's not possible. The financial person has to have the long-term perspective to look at the recovery aspects and also sustaining the growth aspects. However, the financial leader has the responsibility to ensure that the costs are taken out, particularly the wasteful costs are taken out, making use of these developments. Another important question for the finance leader is the funding of the business. It could be through equity or debt or a combination of both, and it should also have a good measure of internal generations. And finally, the question for the financial leader along with the leadership team is how will the firm maximize its value to its shareholders? Firms are moving away from singular measures of firm's performance and instead use a set of measures that lead to wealth maximization. Financial strategy of a firm involves a few critical decisions, and these decisions are led in terms of both deliberation as well as resolution by the financial leader. They require significant amounts of data processing, although in a business context. The financial leader does not win by saving. He wins by spending to generate more cash. Key financial decisions of a firm are the investment decisions, the financing decisions, the liquidity decisions, and the dividend decisions. Investment decisions deal with putting money into the company for growth. Financing decisions mean financing the working capital cycle of the firm as also several operations of the company. Liquidity decisions relate to the cash levels that could be generated and that need to be maintained. Dividend decisions relate to the money that could be paid back to the shareholders so that their investments fetch some returns. Each decision, singularly and collectively, impacts the firm's return as well as risk. It is the responsibility of the financial and business leaders to take optimal financial decisions on one hand and establish the optimal risk return trade off for various business decisions on the other hand. Financial decisions, as I said, are influenced by many factors, and these factors, again, through this concentric circle model, are the firm being at the core and center of the ecosystem. The firm operates in an industry, and the industry has certain characteristics. The firm cannot completely escape from those characteristics, but at the same time, the firm can be better than the industry average on many counts. Then we have the national economy, the macroeconomic factors, the microeconomic factors impact the financial decisions of the firm, and finally, the global economic factors. Global liquidity has also become a very important aspect of the financial path of the firm because that is as important as internal profitability today. When the firms can raise finances globally, the firms should be well positioned to raise those finances, but it cannot come in a jiffy. It requires appropriate rating of the firm's physical and financial performance by independent rating agencies, which means that the company has to be run on prudential principles and the company should have good growth prospects. Therefore, the extent of knowledge that a finance leader needs has grown manifold over the last several years. A financial leader must be savvy about both business and economy, and the number of factors which he needs to take into account for developing financial strategy are a huge number. Some of these are mentioned here in a 25 factor matrix: consumer optimism, GDP growth, inflation, demographics, subsidies, consumer spending, sectoral growth, unemployment, formation of jobs, purchasing power, gross domestic savings, money in circulation, inequalities, credit availability, gross capital formation, interest rates, financial market stability, international trade, balance of payments, foreign direct investments, exchange rates, international ratings, overall debt, government debt, similar global economic parameters. The nature of each business influences the pattern of correlation between economic and business factors. If there is a company which has got manufacturing and R&D sites across the globe and also sells its products across the globe, then the requirement of the exchange rate regimes in various jurisdictions and the related tax regimes is an important aspect of the financial leadership in that company. Financial strategy is closely linked to other factors: corporate governance, ethics, compliance, business continuity, risk management, and even the broader ESG leadership are now integral to financial management. The CFO must therefore set the highest standards of probity in the firm. Corporate governance ensures that the company is run on prudential lines. Ethics and compliance ensures that the firm is an honest corporate citizen. Business continuity and risk management ensures that the business is made robust against potential disruptions and risks, including cyber attacks. Financial management is relied upon to ensure operational integrity and business continuity of a firm, not merely wealth maximization for the current situation. As we all know, investment decisions have to be taken by firms all the time, but investment decisions are based on the project profiles that the teams generate, and project profiles are approved only when they are considered feasible and viable. While the technical leaders provide guidance on the technical feasibility of the project, the financial viability is carried out by both the financial leaders as well as the operational and technical leaders. Every project is long term in nature with current and future cash outflows and cash inflows. Time value of money is very important in financial management, which is generally expressed by the required rate of return. The required rate of return is set higher than the cost of capital of the firm, and cost of capital is the compensation for the time and risk involved in various projects. And cost of capital is defined as the weighted average of the cost of debt and equity of the firm. There is no one fixed cost of capital for a firm. It keeps varying depending upon the costs of equity as well as the costs of debt. Equity may not have explicit cost as the payments of dividends is not mandatory. However, the opportunity cost of equity capital must be imputed in the cost of capital calculations. The cost of capital could also be set based on the investor expectations of dividends and capital gains. Startups which rely overwhelmingly on equity capital tend to ignore the importance of assessing the cost of equity. Startups feel that equity is available at high premia and less, which is a wrong notion. Startups must assess their projects with appropriate hurdle rates related to cost of capital. Then only they will understand the viability of the project on an expected commercial run. Financial decisions are based on scale, scope, and efficiency. If the business or the firm is to be managed efficiently and effectively, the quantum of funds required for the operations and the surpluses generated from operations have to be managed diligently. As a principle, fixed assets, which are long term in nature, must be financed by long term debt or equity. Fixed assets must provide reasonable return in the envisaged time frame, otherwise, projects become non performing assets. Equally, liquid assets must be financed by short term working capital. When we say liquid assets, we talk about inventory. Predictability and stability of business assures good inventory management. Per contra, to be effective in working capital management, the firm must be able to predict the demand for its products accurately. Inventory management is a critical aspect of working capital management. Just-in-time inventory management, as we have seen, reduces the cash locked up idly in inventory. Inventory turns, that is the speed with which inventory is turned around, that is converted into cash, influences profitability. Again, coming to the issue of startups, startups also must start injecting debt to fund the operations at an appropriate time so that the equity infusion is minimized and stake dilution is also minimized. And also, getting debt into the company ensures that the product and marketing decisions as well as the manufacturing decisions are made with an eye on prudential commercial principles. That is, every product must have to pay for itself. This requires, of course, validated prototypes and a robust sales and production model. The first two principles which I mentioned, that is, the long-term assets must be financed by long-term debt or equity, and the short-term assets must be financed by short-term working capital, is extremely important. When companies start directing the long-term capital for short-term financing or use up the short-term financing into long-term asset creation, the company gets into a debt trap, and it would be kind of log jammed in terms of the use of debt in running the operations or investing for the future. Financial forecasting and modeling is as important as demand forecasting and modeling. It is an integral part of business planning, but is more than conversion of business plan into financial numbers. A number of variables have to be forecast by the financial analyst. For example, the interest rates that the capital demands, the commodity rates which materials and utilities demand, and the wages and salary levels in an organization. These are just three of the input factors, and the conversion standards have to be determined with respect to each firm's capabilities and aspiration. At the end of this analysis, you get physical and financial performance of the company. Ability to predict future trend of various input variables is a collaborative cross-functional effort with the trends and metrics getting expressed financially. A finance leader will not be able to predict the commodity rates all by himself or herself. It requires inputs from the supply chain management. Therefore, operations and finance have to work together in generating the commodity rates. Similarly, finance and HR have to work together to generate the wage and salary rates. Let's look at financial ratio analysis. While this lecture is not about financial management, I thought that you must understand how the financial ratio analysis can be a great lever for the finance leadership to govern the financial health of the company. There are four types of ratios: liquidity ratios, leverage ratios, activity ratios, and profitability ratios. Liquidity ratios measure the firm's ability to meet current obligations. It is like a current ratio, current assets by current liabilities. Leverage ratios mention the proportion of debt and equity in financing the firm's assets. Activity ratios reflect the firm's efficiency in utilizing its assets. And finally, the profitability ratios, which are probably the easiest to look at, measure the overall performance and effectiveness of the firm. If you want to have a comprehensive ratio analysis discussion, please refer to the book Financial Management by I.M. Pandey, which is an authority on this subject. Financial ratio analysis indicates the financial health of the firm, I said, and various ratios are indicative of the foundational attributes of the company based on which the financial strategy and business strategy of the firm can be structured. And mind you, the strength of the ratios and the predictability of the outcomes is based on the integrity of the data that is put into those ratios. So profitability analysis tells us the current and future profitability. Source of profit and loss are also provided by that. Return on investment is brought out through those ratios, and ability to remain profitable with and without new projects can be measured by profitability analysis. Liquidity analysis tells us about the solvency of operations in the face of adversities. That is, how many days of debt cover do we have, how many days of interest cover we have. These are the important aspects that come from liquidity analysis. Efficiency in conversion of assets into cash, cash generation and coverage, efficiency in working capital management. Profitability and liquidity of the firm go in hand. Excess liquidity funded by debt saps profitability because profitability is net of all the interest expenses. The so-called strategy of accessing funds at low interest costs could be beneficial when the interest rates are low, but could boomerang when the interest rates firm up. Asset utilization, that is effectiveness in asset utilization for sales, asset heaviness versus asset lightness of the business, the risk level of fixed and sunk costs, the pros and cons of integration are measured by asset utilization ratios. Similarly, capital structure ratios, that is the soundness with reference to the industry characteristics, debt equity ratios, for example, adequacy of cash generation to support debt, valuation of the firm relative to equity, price earnings ratio, and also book value to market cap ratio. These are all the ratios which help understand the strength of the company in terms of its capital structure and market capitalization. And they also provide a headroom to raise equity and or debt. If the debt equity ratio is highly favorable, that is very low debt level relative to equity, you can raise more debt. On the other hand, if you are debt laden with a debt to equity of 2:1 or 3:1, it is time you start raising the equity before the company goes down under. So capital structure ratios are extremely important. Deployment of assets not only impacts profitability but also impacts capital structure requirements. So given these background perspectives, financial strategy must address the following questions. Are the goals, strategies, including day-to-day and long-term operations of the firm, financially sustainable? From a business point of view, from the megatrend point of view, from the operational feasibility point of view, from the technology backbone point of view, other leaders answer. But it is the sole responsibility of the financial leader to say whether the goals and strategies, including practical and strategic operations, are financially sustainable for the long term. That is very important. Long-term sustenance without taking care of the short-term sustenance is also not advisable. That also has to be focused upon. What can financially be done to make the goals, strategies and operations of the firm feasible and viable? How would I reduce the break-even level? How would I make the cash generation cycle better? Those are the kinds of questions which the finance leader should ask and also answer in collaboration with the other leaders. What are the capital structure and financial instrument options available to support capital investment projects for growth? A whole number of equity options are available, including direct equity, preference shares, convertible debentures. Similarly, various options of debt are available, non-convertible debentures, vanilla debt from the banks, or debt that is having long gestation period with a moratorium. Many aspects can be considered. In addition, you can have global depository receipts from the overseas investors, wherein the coupon rate could theoretically be zero, but actually there will be a cumulative of the nominal coupon rate which will need to be paid at the end of the 5-year term. So depending upon your outlook on what the exchange rate would be 5 years down the road and what the business could be 5 years down the road, a financial leader can make a judgment on taking a zero coupon bond, but the bet may go wrong if the business doesn't work out properly or if the exchange rate regime is adverse to the company. So the appropriate capital structure and financial instrument options is a matter of significant experience in the financial leadership system. And also, can the firms raise the required funds we would like to have, but can we raise it? And what are the pros and cons of raising debt and equity at various points of time? Are the covenants of fundraising in the interests of the company and its current shareholders? That is also important because each GDR issue comes with multiple conditionalities. So, reading the fine print and making sure that the firm's position is protected is the job of the finance leader. Similarly, dividend policy. What should be the most appropriate dividend policy to balance the needs to reward shareholders and to retain the earnings to power future growth? Generally, companies are preferred for their high dividend yield, but some companies try to conserve cash by minimizing the dividend and hoping that the increase in the market valuation of the company more than offsets the so-called short-term loss of dividends. Therefore, what is the most appropriate dividend policy that should be adopted by the firm? And also, dividends may be declared even when the company is not doing so well. In exceptional circumstances, if the company has had no record of any break in the dividends and only 1 year there is a situation of loss, at times the companies dip into the general reserves to pay the dividend because they are signaling to the investors and shareholders that the management and the leadership of the company are optimistic of the future sustainability of the business. So dividend decision is a very important strategic decision. Another question is the sensitivity of company's financial profile to anticipated and unanticipated adversities. Financial modeling and analysis should not be a number game. It has to be strategic in nature to shape long-term business plans as well. So, as you talk about these points, you can understand the strategic role of the financial leader. He is no longer an accountant. He is no longer a gatekeeper. He is one who makes strategy happen. And he is also the one who understands the strategic implications of the financial decisions. As I said, dividend decision is crucial for an operating firm, and dividend policy determines the amount of earnings to be distributed to the shareholders and the amount to be retained in the firm. Dividend decision is based on current operations as well as the future potential of the company. There could be two types of dividend yield companies, low or high. Similarly, the capital gains, that is appreciation in the stock price, could be low or high. Low dividend payout, low capital gains companies are not preferred by the investors. On the other hand, certain class of investors prefer high dividend payout even if the capital gains is nominal. Some investors who have got really a long-term horizon, particularly the private equity investors and others, may prefer a low dividend payout and high capital gains company. Ideal, of course, is a high dividend payout and high capital gains company. This is the company with the virtuous business model, which is highly profitable and highly growth oriented. Again, dividend payouts and capital gains of a firm are not necessarily correlated. Just because a company pays high dividends, it doesn't mean that the company would be appreciated in terms of market values significantly. So there is no specific relationship because the market value of a particular stock is a function of several other factors apart from today's profitability that enables payment of dividend. Capital budgeting is another very important aspect of financial leadership. Capital budgeting is the allocation of capital into futuristic projects. Capital budgeting domain sets realistic cash flow assumptions and forecasts for the company. It calculates cost of capital, sets the discount rates as the appropriate costs of capital. It calculates the present value of cash inflows and cash outflows, computes net present value or NPV as the surplus of cash inflows or cash outflows, and finally guides us whether the project should be accepted if the NPV is positive. So discounted cash flow criteria are their net present value, internal rate of return, profitability index. There are non-discounted cash flow criteria as well: payback period, discounted payback, and accounting rate of return. In the event of many projects should be ranked based on NPV, but NPVs themselves may vary based on the cost of capital assumptions. The assumptions on cash flows and cost of capital would determine how correct the results would be. There are other capital budgeting techniques as well. Various other rules seek to provide different perspectives to study projects. All of them are sensitive to cash flows and discounting rates that are used. Internal rate of return looks at the NPV becoming zero and the point at which the NPV, that is the net present value, becomes zero. That rate should be higher than the opportunity cost of capital. In the payback period, which is the simplest and most popularly used methods, the period is derived by dividing cash outlay by the annual cash inflow. If total cash outlay on a project is 1000 crores and every year 100 crores is being brought in, the payback period is 10 years. And in long-term projects, payback obviously would distort the picture. All methods including NPV, IRR and payback have their value and limitations. A study of cash flow patterns is vital to choose the appropriate tool. How the cash flow patterns increase, what is the curve that would happen. In the event of many projects should be ranked based on NPV, as I said, but NPVs could vary based on the cost of capital. There are various other financial models also, and the financial leader must be expert in those models. I have given those models here: ABC analysis, receivables and payables models, Black-Scholes model, break-even analysis model, cash forecasting model, capital asset pricing model, basically for portfolio selection, cash flow models, discriminant analysis, enterprise valuation models, merger and acquisition models, risk management models, working capital models. The sum and substance is that the financial leader must be a wizard in modeling. And the models could be static models or dynamic models. Static models are those that are based on retrospective data and information, which are usually collected through the information technology system of the company, and where there is very limited guidance available on the future trends related to the current data availability. In the dynamic models, you have both retrospective and prospective data and information. These are collected not only through the IT systems but also projected through data analytics, and these provide more insightful guidance with artificial intelligence. However, all financial modeling is one of simulation of one scenario or a number of scenarios. The business leader's judgment comes in as a very important factor in deciding which model needs to be accepted, because what looks financially very attractive may not be the best strategic approach to be adopted under certain circumstances. So intuition and the wisdom and the judgmental capability of the financial leader as well as the business leader are extremely important. What are the key financial goals? I would say that there are 4 types of goals. One is the level maximization, which means the book value of my net worth should be the maximum. Market value per share should be the highest. Cash flow per share should be the highest. I should have the highest gross margin or EBITDA. On the other hand, you may look at ratio maximization, that is, price earnings ratio must be very good. Market rate of return should be the highest. The project should give the maximal return on investment. Net profit to net worth should be the highest. Net profit margin should be leading in the industry, and market share should be the highest. You may look at liquidity maximization approach, that is, profitability itself should be of very high order. Cash flows must be of very high order. This is the liquidity maximization approach. There could be also a growth maximization approach of maximizing the revenues, asset base and earnings per share. Sustainable operating profitability should be the goal of all startup founders as well as enterprise leaders, whether they are of established companies or family owned companies. The CFO and the firm are judged by multiple parameters, not just one measure of thinking. I have listed here certain measures, 9 to be precise, as to what could be such strategic and operational judgment factors. So EBIT to sales is another important criteria, PBT to sales, then profit after tax to sales, EBIT to total assets, R to net assets, PAT to net assets, return on equity and return on equity plus debt. All of these things are important. Many times we make judgment by looking at return on equity, but that is not so. Enterprise value is nothing but equity and debt together, and if you have non-prudential buildup of debt, your return will have to show a lower level in judgment with respect to the industry parameters. That is important. Again, all these ratios reflect strategic excellence, operational excellence, multifunctional excellence, and finally financial excellence. The financial leader therefore has a stake in the excellence of all the functions, because their combined performance is contributing to the financial excellence for the firm as a whole. Finance and strategy, these are the 2 inseparable leadership twins. There was a time when CEOs used to rely on CFOs to oversee strategy. A strategic plan was seen as a financial plan in the ultimate analysis. However, from the 1980s, strategy has come on its own. The financial leader should be strategic in thinking, while the operation leader needs to be operationally savvy and sensitive, but also be strategically oriented. CFO has the fiduciary responsibility, quantitative mindset, eye on viability, blocking current cash. Whereas CSO, that is the Chief Strategy Officer, not to be confused with Chief Scientific Officer, he has the growth responsibility, qualitative mindset, eye on differentiation, and unlocking future value. The conflicts could arise in terms of capital allocation and the risk reward assessment. The financial leader, if he or she is at loggerheads with other functional leaders, could be a drain on the CEO's energy. It could even lead to organizational stress. The financial leader should take the lead for ensuring that there is harmony amongst various domains, and the harmony is often disrupted by the requirements for investments by the various domains, by the way the operational costs are built into the company's model, and the way the actual performance pans out. So these are the causes of stress. But if these stressful factors are not resolved amicably between the various domains and the CFO, the company itself will go into distress. It is important, therefore, the financial leader has the ability to interact with all the functional leaders for operational sustainability as well as strategic sustainability. And he should also, therefore, take the lead role in supporting the strategic agenda objectively while reporting to the board. CFO approaches to strategy are varied. Deloitte has made a good study of the various approaches CFOs take to strategy in large companies. The challenge for CFO is to choose effective ways to engage in the strategy process in the context of the company's business, leadership, and directors. The CFO has to be independent because he is ultimately responsible for the fiduciary performance of the company, but at the same time, he or she cannot distance himself or herself from the strategy execution or the strategy planning itself. Therefore, the CFO has a tough balancing act. There are 4 ways in which the CFO would act, and these approaches are neither static nor mutually exclusive. The first way is to be a responder, that is, helping the strategy process with financial modeling toolkit. All these toolkits which we discussed in the previous slides, whether it is the capital budgeting toolkit or the ratio analysis toolkit or financial modeling, these could be made available to the strategy planning person and say that I am available at your service to develop an excellent financial plan out of your strategy plan. The role is just one of responder. The CFO could also assume the role of challenger, that is, keep challenging the strategy through critical questioning and improvement. Why should you invest so much in this particular plant? Why can't you raise the level of production in this current plant? Why can't you utilize contract labor in place of fixed labor? Why can't you debottleneck through marginal investments rather than look at a brand new plant? So these are the kind of critical questions which the CFO comes up with to challenge the strategy. But rarely the CFO may not provide complete solutions. The idea is to challenge the domain to come up with its own solutions. There could also be the architect approach, that is, the CFO supports the strategy by strengthening finance as a business partner. That is, finance and the domain works closely together, and the finance leader is very empathetic to the needs of the domain and sees how the finance function could respond to support those needs. Transformer. He co-develops the strategy by engaging in product market and business portfolio areas as well. So he helps transform the business of the company by being one with all the product market actions, all the R&D, operational, marketing, and HR actions that the company would need to take. So these are the basic 4 approaches that a CFO could take, and all the 4 CFO orientations are relevant under various circumstances. One could be a challenger and also an architect. One could be an architect as also a transformer. But being just a responder is hardly doing justice to the role of CFO in current circumstances. So the option analysis is also a four-step process. Analyze the options, help select good options, help develop good options, and jointly develop good strategy. So these are the ways you can conduct yourself as the CFO. These four CFO orientations will help CFOs, CEOs, boards, and business unit leaders establish mutual expectations in a much better fashion. It will also put some kind of service level arrangement between the CFO as the accounting gatekeeper and the financial gatekeeper vis-a-vis a CFO who also has to support the business through investments and expenditure commitment. So these two can be merged together in a very harmonious way when the CFO adopts each of these four approaches in an appropriate manner. What are the changes in CFO focus that have happened over the last several years of increased globalization and cross-border transactions? From an accounting and performance measurement focus, now we have that as well as business sensitivity with openness for futuristic bets. Today's CFO is not expected to possess only accounting and quantitative skills and have only audit capabilities. A digitized interplay of business and financial models should also be the superstructure over these accounting and quantitative skills. Country-specific financial management gets added by global financial management. Routine standardized thinking has to be actually substituted by critical and strategic thinking. Emphasis on integrity and compliance must continue to be there, but the financial leader must be able to set ethical standards. Organic growth and local acquisitions get enhanced by cross-border mergers and acquisitions. Understanding of operations that needs to be drilled down further into understanding of product and process technologies. What does this technology mean? Why are the operations leader asking for updating of manufacturing technology? Why does the R&D leader wants a completely different product profile? What are the merits and demerits? Those appreciations must come naturally to the CFO of today's situation. Risk is signified usually by losses, but risk has to be measured in terms of business continuity and sustainability. Budget systems and controls orientation is the strong point of traditional CFO, but that should be supplemented and moderated where required by strategic thinking and execution orientation. CFO is very comfortable in operating in a predictable regulatory and tax environment. While that is good, the CFO must be bracing himself for dynamic multi-country regulatory regime as well as tax laws. Management of internal stakeholders is not sufficient. Management of external stakeholders is very much important. Today, investor relations as well as media communications are being increasingly handled by chief financial officers, at times of course supported by CSO or COO. Reporting to the CEO is getting added with reporting to the board as needed, and certainly to the audit committee of the board. The CFOs of the future will operate around the globe in multiple time zones and will regularly partner with non-financial areas of business. They would be focusing on growth initiatives and international expansion as much as making the current operations solid and sustainable. Thus, they will need both a commercial sensitivity and sensibility and also a global mindset, in addition to the traditional cost, pricing, accounting, and audit mindsets. That is the change that is required. Having come to this, we should also talk about the transitions in CFO roles. Earlier, CFO used to stop at the pinnacle of his career as the CFO only. But given the huge expectations on the CFO role on one hand, and the firm's growth ambitions on the other, CFO transitions have become extremely important, and companies are resorting to CFO transitions from outside the company system also, if the growth impulse can be generated through such CFO transitions. If the scale of firm is small and mid cap, there could be adequate internal CFO talent. Examples: textiles, apparel, footwear, and various other micro, small, medium enterprises. These companies need not look around too much for getting the appropriate talent, because mostly the existing talent will be sufficient, because the strategic scope is somewhat limited. But let's look at some large cap companies such as FMCG, retail, infra, technology, media, banks, insurance. These are large cap companies, but they are so large again in their operations. Adequate internal talent is likely to be available in terms of growth. That's why Hindustan Lever, Larsen and Toubro, and such other companies have been able to get the chief financial officers from the internal systems. Then you may have a small and mid cap, but they are in fields which are just emerging, like small banks, non-banking finance corporations, mutual fund industries, hospitals, service industries. These are not very large in terms of scale of operations, but they require a new type of expertise. Therefore, small banks may look into talent that is available from banking system. Similarly, NBFCs, hospitals may look for service-oriented people from FMCG. So the external input is required for such companies. Then, of course, there are large cap companies which want to transform themselves. Automobile, engineering, chemicals, pharmaceuticals. These are highly global companies with much greater potential for transformation. They may look for CFOs from external industrial situations. We have had several CFO transitions that are, for example, Royal Enfield's latest CFO addition is from the beverages industry. We have those examples. People from consulting industry come into the automobile industry. We have seen also that amongst various skills that are portable across industries, finance happens to be one such domain, apart from human resources. So the portability of skill that is there, assuming that the leader has the requisite grasp, people could be brought in from other industries to power the growth of the firm in one particular industry. So growth, turnaround, transformation increase the need for step up external hires. Those external hires are expected to step up in their own roles and also help the company step up to a new level. And also one more important aspect is that the CFO transition from outside the industry facilitates one's progression into CEO roles, because by doing that the CFO gets a multi-industry perspective. There are many such cases of CFO transitions into CEO roles. I am giving you some examples. Rajesh Gopinathan, he became CFO to CEO, and it was an internal move. Sunil Mathur, he has moved from CFO position to CEO in Siemens India. That is an internal move. S. Sridhar, he was the CFO at Pfizer Limited in India, and he moved into CEO role. But he came in externally into the CFO role and moved into the CEO role internally. Umang Ora, CFO to CEO. He came from Dr. Reddy's into Cipla as a CFO and then moved on into the full-fledged CEO role. NS Kannan, CFO to CEO, ICICI Prudential, it's an external move. Came in as a CFO from elsewhere and became this ICICI. SK Nag, CFO to CEO in Quest Corporation, it has been an internal move. So typically CFOs who perform step-up roles internally are inducted from outside to support growth, turnaround or transformation seem to be the top picks for moving to CEO roles in the high performance firms. That is, if the CEO sees the CFO performing admirably well in turnaround situations or powering growth or powering transformation of the company, the CEO will be very happy to recommend such a CFO as a CEO. The boards also will be accepting such propositions. In an environment that traditionally favored heads of operations or heads of sales to move into CEO positions, the increasing trend of CEOs staking their claim for CEO positions is certainly interesting. The leadership characteristics of individual financial leaders play a significant role in such up moves. We cannot say as of today that this is a very defined, clear path for the CFOs, but those CFOs who have unshackled themselves of the traditional accounting and audit mindset, and those who have acquired the flair for being strategic partners, for being business partners while retaining the accounting and audit capability, these people are stepping up as the potential CEOs in companies. There has also been an article, why CFOs make good CEOs. A few reasons. One, they can handle money like no one else, and cash is the king at all times. Have a 360-degree view, strategic understanding of business, because every financial plan has to be expressed in financial terms at some point of time or the other, and the execution is also related to the financial aspects. There should be a very strong understanding of boards and investors in any CEO appointment, and CFOs interact with the board almost as much as the CEO does. Therefore, a strong acumen in risk management comes up in the CFO mindset, which makes for good CEOs. And as I said, if they have deep involvement in strategy, mergers and acquisitions, due diligence, corporate governance, that makes them even more qualified to become good CEOs. And as I said, the CFO should understand the investor mindset and be able to influence it in a positive manner based on the positive performance of the company. Similarly, the CFO must be able to interact with regulators and discuss various aspects related to the financial position and strategy of the company. So, ability to raise the bar on process, ability to raise performance of the company, ability to rise up to the expectations of the board and investors are key parameters in a CFO making the grade as a good CEO. While a lot may be going for the CFOs to be elevated to CEO roles on the above considerations, management of board and investor expectations alone cannot be seen to be the route to such progress. The claims from R&D leadership which innovates new products and operations leadership which delivers the products are strong too. The lesson from this is that if those leaders, that is the technical leaders, the R&D leaders and the operations leaders have that financial acumen, and if the financial leaders have the necessary technical acumen, all of them will be on a level playing field as far as the contending process for the leadership of the company goes. That's the main lesson. And when you go back to the senior leaders I discussed, I talked about technology leaders being very financially savvy and vice versa. That's how CFOs could make good CEOs as well. Financial strategy should guide but not dictate business strategy. Any amount of financial analysis cannot be the sole criterion for deciding whether the financial analysis is superior to the business strategy, because a company cannot be governed only by profit maximization principles or shareholder wealth maximization criteria. Financial priorities can dramatically change with volatility in economic and business environment, but sound technology and sound operations continue to play a lead role, and they provide sustainability for the organization. Therefore, finance cannot dominate the basic foundational requirements of technology or operations. A company's strategic enterprise value is determined not merely by the financial value but also by various other intangibles, including brand equity, infrastructural strength, R&D capability, and many others which cannot be given in a financial value, but they all will be assessed by the investors. Financial strategy without relation to business realities could be draconian and destroy long-term investor wealth. So, while analyzing the financial strategy, the business strategy also should be given equal importance, and ultimately it is the business strategy that should prevail with appropriate inputs from the financial strategy. The CEO CFO personality partnership is again a very important aspect given the key role finance plays. It is generally considered that CEOs tend to be optimistic and risk taking, while CFOs tend to be cautious, if not conservative and pessimistic. This need not be the only case. CEOs and CFOs can both be optimistic or pessimistic too. Here I have presented a matrix when I try to map the CFO personality and the CEO personality in respect of cautious and optimistic as the case could be. If the CFO is a cautious person, the CEO also is a cautious person, that firm is bound to get stuck in the zone of comfort with little growth. If the CFO is optimistic and the CEO is cautious, the firm lays a good plan for organic growth fueled by internal enterprise, internal cash generation. On the other hand, if the CFO is very cautious but the CEO is very aggressive or optimistic, the company is bound to see roller coaster growth with internal stress factors at play. If the CFO is optimistic and so is the CEO, then you will have merger and acquisition led growth even at hefty valuation, because both are optimistic that they would make the acquisition succeed. Growth, turnaround, transformation, they have these requirements for different kinds of personality makeups. By and large, finance leadership is portable across industries and firms. Having looked at all of these things, I come to the characteristics of financial leader. We can identify the characteristics of financial leader from the deep and extensive discussion we had so far, and the key attributes can be expressed as follows. Should be a role model in fulfilling fiduciary responsibility for the company, setting the right tone at the top along with the CEO. should have the focus to maximize current operations but also the vision to invest for new businesses. He should be a collaborator and integrator working with various functions of the firm, especially R&D, operations, marketing and human resources. The finance leader should have the ability to interpret and influence business and operational integrity with metrics and stage gates. Should be tactical in execution and strategic in thinking. Capable of zero-based budgeting if circumstances so demand. Should have a thorough knowledge of deploying digital tools and methodologies to connect and model business operations, the past, present, and the future. The financial leader should have the ability to generate cash for today's sustenance in working tandem with the operations leaders, should be able to generate capital for tomorrow's growth, and should have the ability to inspire confidence on the part of bankers and investors. A successful financial leader is one who understands the link between strategy and execution and partners the CEO in driving business in current, emerging, and futuristic horizons simultaneously. And to be able to lead the finance function, if those are the special characteristics, there are certain characteristics of the 30 attribute cluster which would help him. All the 30 characteristics, the 10 developmental characteristics, the 10 performance qualities, and the 10 apex qualities are equally important. However, to be a finance leader possessing those special characteristics, you need to have certain extra emphasis on certain characters. For example, the finance leader should be empathetic towards the requirements of the various functions. The finance leader should have the passion for business and courage to call a spade when it needs to be called out. Integrity certainly should be of the highest order. Ability to mentor other domains. Should have the aspiration to grow the business or turn around the business matched by commitment. So the development attributes come out in this fashion, and when they are converted into the special characteristics, the financial leader will be winning leader. Similarly, within performance dimension, several characteristics which we have talked about are extremely important. Several qualities of performance are required, such as knowledge, vision, strategy, execution, conceptual, analytical, decisiveness, communication, collaboration, as well as negotiation. As in the case of operations leader, a finance leader also requires the whole set of performance attributes. And from the apex cluster, the financial leader would require stature, innovation, intuition, inspiration, networking, ethics, objectivity. Again, as I said, in respect of the other three leaders, the emphasis in bold does not mean that the other factors are low in importance when a finance leader is engaged in ensuring financial stability and business growth. It only means that the emphasized factors drive the selection of leader personality to a greater degree. And worth repeating, the performance aspects of financial leader are extremely important for the finance leader to succeed, as much as the developmental factors and certain select apex factors. Financial leader is kind of glue or the bond that holds all the domain leaders together. And the greater the non-financial acumen the finance leader displays, the greater would be the potential to move into a CEO position. Again, as I said in the beginning, nobody has grown by cutting down businesses or conserving cash. Companies have grown by increasing scale of operations and also deploying cash in a worthwhile manner, in a strategic manner, and in a profitable manner. The financial leader must have that strategic outlook along with operational rigor to be able to step into the CEO shoes. So with this, we'll come to this end of this lecture and we'll meet in the next lecture. Thank you.